Hello everyone, welcome to this video in which we're going to discuss about gold. Gold has been a great investment this year with a performance of over 70% year to date. It's an important part of our portfolio construction process, and we have the pleasure to have with us today two expert investors in the precious metal. We have Ned Naylor with us. Ned is the portfolio manager of the Jupiter Gold and Silver Fund. He's one of the most experienced gold managers over the world. And we have Miguel Mayo with us, which many of you may already know. He's the member of the investment committee and portfolio manager of the Paradigma Stable Return Fund. He's a global macro investor, expert in both commodities, FX, and general markets. But he's got a strong view on portfolio construction on gold. So I think we'll have two interesting points of view here. Thank you very much. Just with a bit of the background that you see of gold and what you expect from now, but maybe what has happened and your theory of that. I mean, it was interesting. I don't know how you will tell it in the video, but that image that we always keep in my mind is the gold with that sword almost to cut the dollar head. You explained that very well, but just for we get to understand your views, and then Miguel, you can share what you're doing and how you're seeing the things in gold, and then we'll go to the concrete questions probably.
Sure, of course, Diego. First of all, thank you for the opportunity to discuss what you know is my favorite topic. I could do this all day long. So look, I think that there are a couple of things that are worth mentioning here. The first is that gold is measuring the performance of your local currency. So in your version, it's euros. Here, it's sterling, and in global financial markets, it's dollars. So the reason people talk about gold and they just think in dollars is because the dollar and the treasury market really, rather than the dollar, has been the principal risk-free form of money in the system, certainly since the early 1970s. So people, as a result, obsess about the relationship between gold and dollars because there is that risk-free debate happening. You know, what is risk-free? And it can only really be one or the other. Although what we've seen in the last few years is that split apart, and the financial system continues to use US Treasuries as risk-free, where the central banking and government community have moved back to gold. And I find that this split between the two communities very interesting and important. And I think it's something which merits further discussion and probably merits allocation as well in terms of what investors should do.
Moving to a regime where, you know, the level of debt in the global financial system is sovereign debt especially is so high that it's being questioned as a risk-free asset. No? And we are seeing that the long end of many curves, interest rate curves in the world are struggling. We've seen it in Japan where 30-year bonds yields are making new highs, and we're seeing that also to an extent in the UK. So yeah, I tend to agree with this view, and so here the issue for us when we started our strategy was by default it's a 50% equity, 50% fixed income split. But we took the strategic decision to take 5% out of our fixed income book and put it into gold. No, when we started 2.5 years ago, and it was the reason was precisely what Ned is commenting now, that for us we were not as comfortable with fixed income in the very long term, and we thought that gold would slowly be occupying more of that role. And we've kept it since. So it's certainly a big point, from the macro point of view. And gold has also proven that it's been a great diversifier in portfolios over decades. It's not something that has just joined the investment universe a few years ago. So it's been around for a long time, and it has proven its worth. So it's important from that point of view as well.
So what are the drivers for gold now? And what are the main things that we should be looking at, trying to guess something that is probably not a good idea, but trying to guess if we should have more or less gold for next year?
So look, I think, Diego, that you need to remember that gold's measuring your local currency again, just to repeat myself. So what we're saying here is, do you think the direction of travel or government spending and debasement will continue in the next 12 months. Now, if you do, your local gold price will carry on going up. I mean, at the current rate, you would expect it would be similar to this year. Now, that's quite a fancy quantum. It's a lot. But I think that unless there's a change in policy, and I mean a U-turn from dovish and cutting and debasing back to being hawkish and doing hikes, then I think the direction of travel is very much set here. Now, what has happened is we have started to see in the last year and a half, the entrance of very sophisticated, leveraged pools of capital. So that's hedge funds and CTAs and sophisticated trend following participation. So their continued involvement, I think, can add fuel to what is a quite clear direction of travel macro fire. Look, the principal driver for gold is always the real interest rate projection of your local currency, in your case, euro.
I tend to agree again with Ned. Currency debasement, I'm a buyer of that argument. Again, not because of the huge levels of debt. It's really difficult for governments to run, fiscal surpluses. So we are running fiscal deficits even in a positive macro environment. So traditionally, no fiscal policy should be counter-cyclical, but we're not seeing this now. So whenever there's a crisis, they run out of tools and they start printing money. And again, we go back into this debasement theory, debasement game. So what do you invest in more than it's real assets? And you can consider equities as one of them, but again, gold comes into the fray. It becomes a piece of portfolio allocation. And yes, I think that the gold rally is set to continue now. 50% next year seems a bit aggressive, but again, who knows, right? It's a limited quantity of that asset, and there are huge investment portfolios that might want to have an allocation.
What are the advantages of the other alternative choices, and is it just that we should diversify this strategic allocation that we all agreed makes sense in a portfolio? Or should we move from one to the other depending on timing or market circumstances? How would you recommend to manage that?
Well, look, as you know, yes, we own silver and we own mining companies, in the strategy. But I think the thing to be very clear about is you've got gold, you've got silver. They are monetary metals. Nothing else is a monetary metal. So let's not start discussing platinum or copper used to be a monetary metal, actually. A long time ago, but it's not anymore. And what I mean is that gold and silver trade in foreign exchange markets. It's not my opinion that they're money. They trade in foreign exchange markets. They are money. They are currencies. So what you're doing when you buy gold and silver is you're short your local currency. I know I'm repeating myself here, but it's a very important point. Now, both silver and mining companies are a beta play on gold. Gold is just cash. It's the risk-free form of money. It will buy you the same stuff in 5 years and 10 years as it does today. This is the real hidden secret of gold, is actually measuring purchasing power. It's not really even an investment. It's a very powerful decorrelating asset, but it's not. You're removing your capital. Whereas with silver and miners, what you're saying is, I like this trend. I think this is here to stay, and I would like to turn the volume up on this observation. Now, the best way to do that is silver, and the second best way to do that is mining stocks. And the reason I say the best way is silver is because silver absolutely clearly has a perfect directional relationship with gold. It just does more. And we're really seeing that at the moment. Silver has started to get its trousers on and is really moving. And the paper silver market is very, very big, and potentially can add serious fuel to a much higher rise in the silver price. But the mining companies now are the most profitable, the gold and silver mining companies are the most profitable part of the global equity market. With 50% free cash flow margins, doing buybacks, paying special dividends, lots of merger and acquisition activity. And it's a hugely, not even underpopulated, unpopulated part of the global equity market. Now, I believe that will change. At the moment, people are still stuck on other equity market themes, which is fine, and they continue to sort of stay elevated or even go higher, some of them. But they're very expensive, and gold miners are not only not expensive, they've been getting cheaper. So these are the equities with the biggest free cash flow margins in equity markets. And as free cash flow margins have gone from sort of 15% to 50 over the last 8 years, the stocks have been getting cheaper consistently through that 8-year period.
Given the mandate of our fund, we probably could go into silver, but it's easy to explain that you go into gold, which is already going outside of the common main investment products. But going into silver requires a bit more explaining. But yeah, it has done really, really well over the last 3, 4, 5 months. It's outperformed. It's a high beta gold bet, but it has outperformed that even. So yeah, it's something. I also think that it's money, but with one caveat, is that other currencies, other FX crosses, those can be issued. There can be a limitless amount of those being printed, by the sovereigns. While gold is a much more limited set. There's some gold underground, but you're talking about a limit on the supply side, which you don't have in many of these currencies. And it's one of the reasons why, I also think that many times people talk about an asset doing really well, and sometimes it's not the asset that does well, it's actually, what it is denominated.
Ned, what are you, there's lots of thoughts on gold that may be right or wrong. People sometimes speak on valuation, but there are many other things. So what do you think are the main misunderstandings on gold?
Yeah, so there are several things that are very important misunderstandings. One is how do I value gold? Well, the answer is gold is zero, and it's measuring the rate at which sterling and dollars and euros go down. So it's an inverted question. You're thinking about it the wrong way around. It's the thing you use to value and measure the value of your local currency. So that's a very important point. Now, even I look at it on a screen going up, dollar gold, which is a mistake. Because it's not happening. It's the other way around. It's the currencies going lower. So this is very important.
Then what will be the main risk for gold at this point?
Well, I think Ned touched on this, but the main risk for gold, a change in the current environment. We have so many things going in favor, from economic uncertainty. Equity valuations are very high. The global debt levels we spoke about. The resorting to money printing every time there's a crisis. Geopolitics as well. The questioning of historic alliances. NATO being one of them. The far right voting intentions increasing. So there's so many levels at which gold is supported that you would need a few of those to go the other way. Global peace, all the countries getting together, we're all a happy family. That would go some way into helping that. But again, that's very unlikely. And also technical is extremely supportive. You have a weaker dollar, you have a very strong momentum. A lot of, again, CTAs and trend followers, momentum funds are participating more and more, and they push the price up as well. And then a FOMO psychology, right? The fear of missing out. This year, gold has outperformed almost every equity market, developed equity market in the world. So investors are taking note, and then suddenly they're saying, "Oh, I'm missing out. I do not have gold in my portfolio." So that FOMO psychology is going to keep driving it as well. And also, one point also, the risk of confiscation of your reserves. Your central bank, you have international reserves, in developed countries, in the US or in Europe. In the end, there is a risk that those get confiscated. So it's much safer, after what happened with Russia, to have real assets that you can store yourself, rather than allowing others to have control over your reserves.
Why should we have gold in our portfolios, and what can we expect moving forward?
So I think moving forward, you can expect more of the same. And in terms of why you should own gold, I will refer you to the Irish playwright, George Bernard Shaw, who said, I think it's about 120 years ago, Diego, he came out with the following quote, which I think is a good way of framing why you need to own gold, which is, given the choice between trusting the honesty and discipline of members of the government and the honesty and discipline of gold, with all due respect to those gentlemen, I strongly suggest you vote for gold.
I think we're moving into a more unstable world, and I think 2026 is going to be a really fascinating year in terms of volatility increasing and new trends developing. So I think in a world like that, you need to own the anchor of the financial system, which is in the end is something like gold.